Steve Peterson here with Infinity Investments. Welcome to our channel where we talk all things commercial and investment real estate. And in today's video, we're going to be talking about the number one thing, the number one number or metric that you need to know when buying property in 2023. Now, March 2023 right now, Fed just came out, said they're going to be raising interest rates again. All right. Some of us are not surprised. Some people are shocked. You know, some people, I was hoping they was going to level off, but inflation's out of control. They got to do what they got to do. All right. So we're going to be in a high interest rate environment, at least through this year, probably through next year. Who knows where we go, but beyond that, right? So one thing you really need to know, and we're going to just make this video about one thing. It's the cash on cash return. Very important, all right? Cash on cash return. Because in a high interest rate environment, we need to make sure that we are making positive cash flow and that cash flow represents what's called positive leverage, all right? And what that means essentially is that you're making more money on your money. You're making more money on your money than the bank is making on the money that they lent you. So therefore, you need to understand what the building's cash on cash return is. So let's go through what that means, all right? How do we estimate cash on cash? Well, we have to get to a number called net cash flow. So the net cash flow is, okay, we got to our net operating income, right? Gross income, expenses, net operating income, right? Net operating income pays for the debt service, the mortgage payment, right? The number that's left after that is called net cash flow. That's the money that if you do buy a property, most of us do, with a mortgage, net cash flow is the money you put in your pocket, right? Pre-tax. In order to calculate cash on cash return, we take the net cash flow and we divide it by our initial investment. That's gonna be your down payment and all the closing costs, all right? When you buy a property at close of escrow, you have what's called an initial investment. That's your down payment plus all the money you put down to acquire the property. So in order to calculate the cash on cash return, we take the net cash flow and we divide it by the initial investment, all right? And that's gonna get you a percentage, all right? That percentage should be higher than the percentage on your mortgage, all right? And actually, that percentage should represent for you at least your minimum rate of return. When you invest into a property, you should have a minimum rate of return that you're going after, right? In other words, say, in order for me to spend my money, I've got to make 8%, 10%, 7% cash on cash return. If I can't hit that target, it doesn't make sense for me. Now, a lot of institutional investors may look at other measures, internal rate of return. Some people buy properties just because they want to see them go up in value over the long term. I understand that. But in this environment, if you have negative leverage, that could end up to negative cash flow. It could lead up to negative cash flow, especially if you got adjustable rate mortgages. Not only eating your cash flow, it could start really destroying the property. And that's how a lot of properties get lost. I saw this in the Great Recession, right? So even some people are like, I don't need cash flow. We're going to buy a property that's going to grow in value. In the Bay Area, that happens a lot. However, we need to be aware and concerned with that these days because the interest rates are up significantly year over year. If they're going to go up some more, if you have an interest and a variable rate interest rate, your payment can go up significantly. And so if you're looking at evaluating property, the number one thing that you need to be aware of is your cash on cash return. And I want to see you have positive leverage, meaning that the loan that you got is making you money. You're making money on the bank's money, all right? Negative leverage, meaning that you're losing money on the bank's money. Doesn't, you know, when you get a loan from a bank, you want that to increase your return. Ideally, right? You know, you want it to increase your return. You don't want it to diminish your return, right? And the way you measure that is through what's called cash on cash return. You want that cash on cash return to be higher than the interest rate on your property. And if you follow that, you can weather the storm, you can make profits in this environment, and you can hedge to the best of your ability your downside risk. All right, and that's the type of stuff we need to be doing in this environment. We can't change the rates. You know, I'm in the real estate business in 2022. You know what I kept hearing brokers and agents saying, and this is bad advice, oh, you'll be able to refinance spring 2023. And I don't know where they got that, because they doubled the rates in 1 year. Why would they drop them in the very next spring? You know what I mean? That doesn't make sense within their plan. A lot of us thought, though, that they would level them off and say, hey, we're going to keep them where it's at for a minute. But supposedly inflation's out of hand and they're going to keep raising them. So then therefore we have to have some measures about what we are doing, and we have to order our steps about what we're doing in order to make wise investment decisions. So let me know what you think about it. Holla at me. Hopefully this is helpful. If it is, throw me a like, subscribe, share. You know, if you don't like it, tell me you don't like it. But let's have these kind of conversations. Let's be aware, in that difficult times, they come and they go, right? But wise investors are going to be able to navigate and actually make more money during these times. And remember, an increase in an interest rate in an investor environment, it's going to have some pain. It's going to be some struggle. But we play our cards right, it's going to mean increased rates of return for us as investors. So let's go get it, y'all. Hope this was helpful. To the next video. Deuces.